who visits New Jersey for tourism, first of all? I mean, I'm sure there's some nice things to see in New Jersey. But secondly, like there's a tourism board in New Jersey and they're buying ads in London, like who's going to see that and be like, hey kids, get in the car or we're going to fly to America. We're going to go to New Jersey.
The Business of Betting podcast is presented by Optimove, the #1 CRM marketing solution for the iGaming industry. 4 out of the top 5 U.S. operators personalize player experiences with Optimove, the #1 CRM marketing solution for the iGaming industry. Learn more about Optimove by requesting a demo at optimove.com/businessofbetting. And if you like what you see, you will get your first month free.
What is up, everybody? I am Jason Trost, the host of Business of Betting podcast. We have a special episode today where we're going into the affiliate world because there's been a lot of news in the system. And to talk about that, we're bringing on Adam Small, who is the founder of Third Planet. I think I got that right, Third Planet. I keep thinking Third Rock from the Sun because I'm like, which planet is it? And then I have to think Third Rock from the Sun. I assume you mean Earth in that. Yes.
You got to brush up on your Modest Mouse fanship. I don't know if you listened to them, but yeah, that's mostly came out of their song from about 20 years ago.
Long time. I've been to a Modest Mouse concert, but I probably haven't listened to them very much since then. They've kind of dropped off, haven't they? They were quite big.
Yeah, I actually like the album Third Planet was on. The Moon in Antarctic was far and away my favorite one that they put out. And I haven't really even followed them that closely since then. But I actually wanted to call this company Blind Spot. That was the original idea, which is also from that same song. And there's a line about the boss quitting the job to go out and find blind spots. And I felt like that was exactly, I'd been at Better Collective and working with one of these bigger affiliates. And I decided what I wanted to do was go out and figure out what people weren't doing or weren't doing as well as I thought they could and do it myself. And that's how we ended up where we are.
All right, great. It's funny to hear that name, Modest Mouse. You're bringing back memories. I think we're about the same age. You went to Vanderbilt, right?
Yep, graduated in 2003.
Yeah, I'm a Northwestern guy. Graduated in 2003, so it's kind of the same era. It's like White Stripes was quite big back then. And,
yeah.
Oh my God, Fat Boy Slim. Remember him? What happened to Fat Boy Slim?
Yeah, I guess maybe our next company will have a Fat Boy Slim quote. We actually joke that right when we were forming our company, Better Collective had just acquired Playmaker Capital, and right before that, they'd acquired another company called Playmaker. So we thought about just calling our company Playmaker and seeing if that would lead to a quick acquisition, but thought better of it.
Great. So we're recording this November 1st. I'm having trouble thinking about anything outside the election. How are you in election mania? Are you nervous or are you sanguine about it?
I'm trying not to be too worried about it and remember that, we go through these cycles and mostly what ends up happening is you get very upset or elated or whatever, and then you move on with your life. And trying to think like that, obviously, not everybody gets to do that. Some people are affected in bigger ways than others, but I don't like to sit around worrying about it all day and try not to.
Yeah. Well, I've not been successful at it. So my hat's off to you. Well, I hope for the best for our country that we make it out alive one way or the other.
Totally.
Great. All right. So affiliates. So if you're listening to this podcast and you don't know what affiliate is, I would define it as, it's a very fancy word, but all it basically means is you kind of pay somebody else to do the marketing for you. So in the traditional advertising model, you put up an ad, they come to you, you own the customer, so to speak. In an affiliate model, it's just a fancy word to say that you're paying somebody else to go find that customer for you, and then you share in the economics. Generally, either you pay per acquisition, you do a revenue share, or you do some kind of split, or there's some other models, but it's generally somewhere between a rev share and a cost per acquisition, the CPA as we call it in the industry. So like a cost per acquisition can range from $10 to $200, say, and a rev share might range from 10% to 30%, might be lifetime, might be 3 years, might be 1 year. There's a bunch of ways to cut up these models. So what I saw in the news was that there's 3 big companies that have made big announcements. They were XL Media divested its remaining assets this week and selling the assets to Sportradar. Catena Media laid off 10% of the staff ahead of their earnings call. And Better Collective announced significant layoffs after its share price dropped 35%. So you're from this world. Even though we get a significant amount of our customers from affiliates, I'm not that familiar with what it's like being on your side of the fence. So Why don't you take the audience a little bit behind the curtain? Like, what is going on in the industry writ large? And maybe you can offer your comments about these three specific customers.
Sure. And just to add on a little bit to the definition of affiliates for those who are less familiar with it, I look at it as we often say performance-based marketing is like when trying to explain the model to people outside the space. And largely what it just means is that instead of getting paid for how many people see your ads, you get paid for how many people you're able to get to take action on them. And so you build your business around conversion rather than around visibility when it comes to, the commercial aspects of your business. So what's going on right now in the industry is basically this. The US, as everybody knows, opened its doors to the proliferation of sports betting around much of the country about 6.5 years ago. There was a little bit going on before then. You had New Jersey in late 2012 passed a law that allowed online casino and online poker to be legalized and regulated in their state. And so there was a bit of a growth of affiliates in poker and casino, mostly casino, during those years leading up to PASPA. And there were affiliates sort of preparing for more states to happen, but there wasn't really that much attention or investment going into it. In late 2016, Catena Media, which is one of the three companies you mentioned before, purchased a suite of sites, including a site that a lot of people know now, Legal Sports Report. But actually, when they bought that company, they were mainly buying it for revenue that was being generated by some other sites in that network, mainly the site playnj.com, which was sending all kinds of players to New Jersey online casinos. And they paid, I believe it ended up being somewhere between 50 and 60 million total. It was, I think, 15 million up front plus an earnout. And that was a big head turner for people who were following the US space. Nobody had really been paying money like that for affiliates, at least on this side of the pond at any point. There had been some big acquisitions over in Europe, but the US was untouchable for that kind of money before then, mostly just because of the uncertainty with offshore markets and payment processing issues and all these other things that were going on forever in the US. So when Catena Media made that acquisition, it really sort of was the beginning of a new paradigm in the US. They had gone public fairly recently at the time. They were flush with capital from their European business and from, letting in public shareholders. They just had a lot more money and were able to pay money that was previously unthinkable for an affiliate business. And not long after, the floodgates kind of opened. PASPA went down in 2018. Sports betting began to get legalized in quite a number of states. Pennsylvania came online in 2019 with both online casino and sports betting. And not long after that, a whole bunch of states came online, including big ones like New York and later Ohio, North Carolina, Michigan. There's quite a bit of the country now that has legal sports betting and a few states that have online casinos. And in 2019, Better Collective came into the US for the first time. They were, I think, globally considered probably the gold standard or close as far as affiliate companies go. They're based in Copenhagen. They have a very successful business around Europe and some other parts of the world. And they had stated publicly that they were setting aside a large amount of money for U.S. acquisitions, but they hadn't actually moved yet. And it turns out their first acquisition was our company, which was actually a merger of three companies. But the main parts that I think people are familiar with are rotogrinders.com, which is a big fantasy sports community, and Tools subscription site, and US Bets and Sports Handle, which were more like search engine focused sites that send traffic to sportsbooks and casinos. And Better Collective would follow that by making a number of other big acquisitions. Vegas Insider, which had been around forever, later on the Action Network for almost $250 million, and several other big ones. And sometime around then, XL Media also got into the fray in the US and purchased Crossing Broad, a big blog in Pennsylvania that was doing well on the affiliate side, and some other associated sites. And there are also other companies, Gambling.com Group, which has bought RotoWire, which has been around forever in the fantasy sports space, and they've also made other acquisitions. And a couple other companies as well that are somewhat less known. So there was this big period of growth, and these companies were paying huge amounts of money for these businesses. Sometimes they were paying 10x multiples or close to that. And they were able to do it because they had shareholders buying into the company. They'd gone public. And because they were trading at very high multiples. So sometimes, if you're trading at, I'm just going to say, let's say 15x. If you're trading at 15x on the stock exchange, and you can buy a company at 10x revenue, and then your share price is up, continuing to reflect that 15x multiple, you can see how the short-term math can work out positively, seemingly so, for these companies. But a lot of the math that got shareholders excited was based around ongoing growth. And the ongoing growth depended on a few factors that may not be the case anymore. It's also possible that things change again in the future and that these companies start going back up. But you had a lot of state launches going on that created revenue growth just kind of natural as these sites were prepared for new state launches and spent a lot of money and time getting ready for them. You had sort of the hope of online casino being legalized in more states, which is something people are still planning for and hoping for. And you had this ongoing influx of capital as there was this gold rush going on with all these operators trying to get as many players as they possibly could. And so there was continuous growth. There was also continuous M&A going on, particularly with the biggest affiliates, where they were able to keep on adding more and more traffic by sort of inorganically growing, by investing their capital into other businesses. And that has been very important to their growth. And then lastly, you had what they call media partnerships, which is where they would actually go, for an example, an affiliate company would partner with the website nj.com, like New Jersey, and they would actually publish content on nj.com that would rank highly in search because nj.com has a high domain authority, is an old site that's well trusted in that area. And they would publish their own content and monetize it themselves and have some sort of revenue split with the site itself. So all of these things provided what appeared to be growth in terms of revenue for these affiliates. But when you start running out of these opportunities, when you have fewer ways to continue making that top line look bigger and bigger, at some point, shareholders, I think, started to take a different view of these companies that, maybe the growth potential isn't the multiple that we thought it was. And, they stopped pumping their money into these, or sometimes even start selling their shares. And it was a model that probably couldn't go on forever, I think. And so these companies are smart. I think Better Collective is extremely smart. I've spent a lot of time with a lot of people there, and I think they'll figure out new strategies. But I think the strategy of simply continuing to augment your revenue by acquiring more businesses or more customers inorganically, in other words, by not actually like growing and investing in new products that, attract new users, they're probably going to have to move away from that going forward.
That was an incredibly detailed answer.
Probably on the longer side of what you were expecting, but I just try to get through it as well as possible, and hopefully that makes some sense.
We've set the scene. Okay. While you were talking, when you said nj.com, I was reminded of, in London, all the taxis have advertisements on the side. And one of the ones that really caught my eye was a tourist advertisement for New Jersey. It was like, come visit New Jersey. And I was thinking, like, holy shit, who visits New Jersey for tourism, first of all? I mean, I'm sure there's some nice things to see in New Jersey. But secondly, like, there's a tourism board in New Jersey and they're buying ads in London. Like, who's going to see that and be like, hey, kids, get in the car, or we're going to fly to America, we're going to go to New Jersey? Kind of cracks me up. Okay, enough New Jersey humor. So if I can summarize that great detailed explanation you just did, it sounded like it's just sort of like the hangover after the party. Like, it's just sort of, times are good, money was easy, now it's getting harder, we're tightening the belt. Is that like the TLDR?
I really think it is. And I think that if the companies that brought a good umbrella, I think we'll be okay. But some of them definitely have all their eggs in one or two baskets, and it could be a lot tougher for them. And I sort of went into this on LinkedIn the other day. I was talking about how you had to improve the breadth of your reach, not just the depth. If you just keep reaching deeper and deeper into that same basket, and then that basket, becomes such a basket anymore, it really becomes a problem.
So what is an example basket? I mean, it's like one bookmaker in one state. Is that an egg in one basket, or are you thinking like Facebook for the US, or like what's your egg in that basket?
Yeah. So one example would be CPC, which is cost per click advertising. Like if your entire business is based around purchasing positions in Google search and monetizing those, that's something that the rug could really get pulled out from under you quickly. The margins could go to zero or less than zero, or, Google could totally change their algorithm and you could spend a year losing money trying to figure out how to win in it again, or, the competition could change. So that would be one example. Another one is SEO, which is really the pool that I swim in probably the most. But if you're just only buying businesses that rank well in search for specific types of terms, this is something I saw specifically with Catena Media's acquisition strategy in the last few years, that they kept buying businesses that kind of competed with each other. They bought businesses that they viewed as threats to their search positions and shored up their search positions, but continued spending more and more money just to kind of have the same thing they already had, which was search dominance. And I think I view breadth more as getting into new sectors, whether that's, social media influencers, whether it's podcasts, whether it's, email marketing. There's an affiliate that I think is really terrific called Betting Hero that just got reacquired by its founders from a public company that does all on the ground marketing. So most of what they do is actually in person, helping people register and sign up and become sports bettors. So there's lots of different ways to do it. And I think that the trap is continuing to acquire more and more sites that just do the same thing.
So you were saying, be careful about, you were saying one egg in one basket would be cost per click optimization on Google, but wasn't that was the case like 20 years ago or 18 years ago or 15, that's always been the case. Is there something new in cost per click that's changed, or it's just the market shifting and you should be extra vigilant?
I don't think that either of those are bad models. I mean, I have a lot of investment into the SEO space personally, and I think it's always going to be important. What I mean is just if you're depending on growing all the time, which these public companies have to do, or else their shareholders just jump ship at some point, if they just keep buying into the same kind of websites and businesses that all do the same thing, I think that is a risky strategy for a public company especially. So it's not to say that any of those strategies are bad in and of themselves, but just the way shareholders evaluate these companies seems to be that they want to see growth all the time, which is, realistically impossible for any company, but that's the way shareholders act. And in order to be growing all the time, I think you've got to have some long-term bets on things that will change and markets that will develop and evolve, and not just, be in on the thing that makes the most money today.
I think you even studied computer science, didn't you?
I did, yeah, a long time ago.
So computers are still here. They're still the same. They're still using zeros and ones. So don't discount your knowledge that you got. Like, we graduated 2003 computer science, and I'm just a little bit curious if you could pull the curtain back on like who goes into affiliates. It's, to me, it's this kind of like shadowy world of these people that don't really have public personas. I mean, I know you post on LinkedIn, but why did you go into affiliate? What got you into the industry?
It was kind of an accident, because I'm definitely not of that ilk, and I've met a lot of that kind of person, like the people that use fake names for their online postings, and like no one knows who they really are, and they have really weird email addresses that no one would ever know was them, and no one knows their real name, etc. So I was actually attending grad school at Vanderbilt in 2004. I ended up dropping out, not finishing my master's, but I was pursuing a master's in computer science, and I was living with a guy named Cal Spears, who's pretty well known in this industry now. He and I both graduated together from Vanderbilt, and we, along with one other roommate, had an apartment together, and we were playing tons of poker online, staying up all night playing sometimes. We were just really into that whole poker boom period. We watched every broadcast, and we were playing a lot online on sites like Ultimate Bet and Party Poker and Poker Stars at the time. And there were all these players that had a following. Like, you'd be watching a certain player play online poker at a table, and there'd be 1,000 people in chat, like trying to talk to them and trying to get to know them. But you didn't even know who the person's real name was. Like, you would Google who is, name the player online, and it would be impossible to figure out who they were. And so the idea that we had initially, and credit to Cal on he'd been working at Rivals.com, which was a growing sort of high school and college sports recruiting community. I'm probably not saying exactly correctly what Rivals.com is. He sort of had the idea based on his time there on trying to get more information out there about these players and to put up ranking for them. And so we just started working on this project. I mean, it wasn't exactly for fun, but I don't think any of us thought it would be our full-time job. And it ended up becoming the website pocketfives.com, which we launched in 2005. And I think that I just sort of decided to become the face of the site, or maybe it just sort of happened by default. Cal was more of like a behind the scenes operator, especially at the time. And our other partner, Riley Bryant, was very much a behind the scenes operator. Like, he doesn't even really have a social media presence or anything like that. And so the three of us were all working on this. I was kind of the only one that was out there talking in public to people about what we were doing, and sort of became that public face. And we did not have a plan for how to make money. We knew about other websites that were out there, and we knew that some of them did make money and some of them made a lot of money, but we didn't really know what that entailed. We heard about affiliate programs. We decided to sign up for some and just like slap some ads on the site as we launched it in hopes that we would get some revenue out of it. And I was still like thinking I was going to apply for jobs and get, some job doing consulting or, whatever people do.
Accenture.
Yeah, no, literally, like I think I was in the third round of interviews for Accenture when we launched the site, and I was like ready to move to Charlotte or wherever they had their office, and a friend of mine had just gotten the job there, and I was like, wow, you're making like $50,000 a year. You are the richest guy I know. Like, I'm going to go do this. So, I mean, I had no idea what I was doing. I just dropped out of grad school. We launched this site, and I told this story to enough people. I don't feel weird saying, I guess, the numbers, at least for early on, but we launched in mid-January 2005. In the month of February, we made about $1,000. And I was like, wow, that's cool. I thought we'd make nothing, And then in March, we made about $5,000. And in April, we made about $18,000. And then it was just like, okay, this is my job now. This is what we do. Cal had left his job at Rivals around the time we launched the site. Riley was still working full time, but had a lot of time on his hands. His job just wasn't that intensive. And we all just basically dove all the way into this. We had no startup costs. I think our startup costs were under $100, which is just unthinkable today. But we wouldn't have had access to funding at that time if we wanted it. We wouldn't have even known how to look for that. We were very green, but very passionate about what we were doing. And it turned out affiliate was the way to monetize that. There were rev share opportunities at the time, and there were, it was a growing space, rapidly growing. So that's how we got in. We had tremendous success those first couple of years of Pocket Fives. It grew beyond, I think, our wildest dreams at the time, especially for guys in their in their early 20s, mid 20s. And then the UIGA hits, which for those, I'm guessing most of your listeners know what the UIGA is, but it kicked a lot of the companies that were serving online poker in the US out at the time, because a lot of them were publicly traded companies that were not able to, I think from a compliance or shareholder relations, whatever it was, they weren't able to continue serving the US. And the US was their biggest market. So Party Poker at the time was the biggest poker site in the US, and they just left right after UIGA. And they still did fine, but they were no longer in the US. And we were very US heavy. So we're all about 25 years old, pretty well financially and so on. But none of us were like, we'll risk going to jail for this. We just didn't know if there would be like legal consequences to continuing to promote. And we all, had our whole lives in front of us. So none of us were interested in, I think moving to Antigua or whatever it would take, or risking anything legally. And we talked to lawyers and nobody knew anything. We talked to the lawyers, they'd be like, well, there's, possible issues or whatever. Anyway, we decided to put the site up for sale. And we, after several months, found a buyer who was actually an American based in Costa Rica. And they had moved down with their affiliate business actually a little before the UIGA, just kind of setting up like a tax situation that was better for them down there. They had acquired several websites that we knew at the time, and the guy had a good reputation. His name's Mike Jackness, since become like a big e-commerce guy. But he ended up buying the site from us, and Cal and I moved down to Costa Rica and lived down there. I lived down there for about 5 years. It turned out I met my wife, got married down there. And then after moving back, after Black Friday in 2011, when kind of the poker thing basically ended, I was like, okay, I'm an affiliate now. And I started another affiliate business and kind of went from there.
You're bringing memories back when I imagine it was fairly similar to you, but graduating in 2003 with a computer science degree, I remember a lot of people saying like it was a stupid degree. All the jobs are going to move to India. It was a very uncool degree at the time. The dot-com crash had just happened. Everybody thought all software engineering jobs are going to go to India. And also like the coolness of startups really hadn't taken off either. Like Facebook hadn't been founded yet. And I remember graduating and not knowing anything about the startup industry outside of like Steve Jobs, Bill Gates, blah, blah, blah. But, there's no Y Combinator. There was no ecosystem for all these things. In hindsight, I probably wish I just picked up sticks and moved to Silicon Valley to kind of get into it. But I remember when I graduated, there was no, I don't know if I knew anybody doing startups or anybody talking about startups.
I really kind of lucked into it in a lot of ways. I was living with Cal, and Cal, I think, just always wanted to own his own business. I think he'd had that in his mind his whole life. And I come from this very like sort of Ivy League background. Like most of my family, my sister's a professor at Yale. My dad went to Dartmouth and Columbia. It's, the whole family's like this. And I think people were very uncomfortable with my career direction around that time. Everyone's cool with it now, but it just seemed very like you're starting a business on the internet. That doesn't sound like a real thing. But I wasn't doing anything else. I wasn't that excited about anything else. And Cal actually this is another tidbit a lot of people don't know. Cal had this trivia business that he'd started, just a side thing during college. And there was a bar in Nashville, it's gone now, called the Flying Saucer. It's a very, very popular place downtown. Cal had managed to get his trivia night into the Flying Saucer on a weekly basis. And so it was like, just a 3-hour, you get in there, you do trivia, they buy a bunch of beer and snacks, and they make money. And he was getting paid weekly for that. And it was a nice little side hustle for him. And we actually met our other partner, Riley Bryant, at that trivia night. He was just a regular visitor there and beer drinker at the Saucer. And so he ended up being a really, really important part of all of our future. He actually was the CTO of Rotor Grinders later on, and is actually currently the CTO of Better Collective US. So he's a very brilliant tech guy and just brilliant guy in general. And we made a lot of lifelong friends there. And that was really actually experience with entrepreneurship, was seeing Cal with the trivia night. It wasn't a, hugely financially successful endeavor, but it was just like, he just decided I could make money by doing this. And then he went and did it. And I had never even thought of doing anything like that.
So this is more of an emotional question, but everybody has different motivations and things that they like to work on in life. And for good reason, we can't all do the same thing. Otherwise it would be quite a shitty world. But I've never, like, for example, agency work, like computer scientists who go to agencies who build products for other people. I've never understood the attraction of that. I would never want to work in a company like that. Bless, people that find that interesting, that's awesome for them. But it just, like, if you wanted to really bum me out, make me go build crappy software for somebody else at another company, that just sounds like the worst, like the Accenture kind of model. I feel that way a little bit about affiliates. It's like you're not the main guy. You're sort of like the messenger on the side, doing the side hustle. Like, why did you never have a crack at doing it yourself?
Becoming an operator.
Yeah.
Yeah, I've definitely seen people go that route. I never had any interest in it, to be honest. I think building gaming products and operating gaming products is such a different type of business than...
Yeah, that's that's what I'm trying to get at. Flip it around the other way. What attracts you about being an affiliate? Because it doesn't, like, intellectually, it doesn't sound exciting for me. But like, what is it to you that like hooks you on this space?
Yeah, I think it's less the aspects of how to convert traffic. I think that is the less interesting part of it all. And I think the more interesting part of it all is how to get traffic, how to build things that people want to look at and that people want to engage with. I think that finding things that people are interested in and learning how to give it to them is the part that I really like out of all this. And then the affiliate model is just the way we know how to monetize it. And there are other ways to monetize traffic, but that's the thing that we figured out in our early days in poker. And it has been certainly, at least up till now, the best way to make money if you're a content creator or a tool creator or anything like that around the gaming industry. I would say subscription would be the one other one that actually has been a decent model for some people, including us with Rotor Grinders. But affiliate's the one that seems to have the most upside right now. So it's a mix of financial opportunity and just having a way to monetize something else that we enjoy doing.
To understand the affiliate space a little bit better, Katina and Better Collective, are they like the Google and Microsoft of affiliates, or are they just sort of like the Burger King of the affiliate space? Like, how would you what's the landscape look like? How many big affiliate companies are there in the world in sports betting?
There are a bunch. Most of them are based in Europe. They aren't the Burger King. Like, it's definitely not. It's not like they own lower quality products or cheaper products than anybody else. So it's definitely not like that. I would say Microsoft or Google. I think Microsoft is actually a really apt analogy in some ways, because they do try to leverage owning a bunch of products that their partners, the operators, care about into getting a higher sort of total hold on. They're trying to get a percent ultimately of all the revenue in the industry. And they're able to get more of that by having more things that their partners need. And so a lot of their acquisitions are about leverage, how to use this thing we bought to get deals that we couldn't get before, or to, even incrementally improve the commissions that we're getting. But a lot of the time it's actually to get commissions on things we weren't even able to get commissions on before. And a lot of the upside that's baked into the share price when it's trading at a high multiple is around this idea that they'll be able to extract more revenue by generating more leverage with these M&A transactions.
Which one's the Microsoft, Better Collective or Katina?
I think they all are. I think they all are trying
all
to be.
Microsoft.
Yeah,
I mean, I my metaphor here.
I don't. They're all different from each other, but Better Collective is probably closer in that they're a lot more diversified. Their assets are.
I guess where I was going with it
is
is like, yeah. Katina and Better Collective. Like, are they collectively, half the industry? Like, what's their market share? These two companies.
It's really hard to say,
give or take.
I think Better Collective is much, much bigger. They're probably bigger than all the other ones combined right now. So they're much more relevant, at least bigger than the other big ones that are in the US combined. But it's significant. I've heard numbers like that affiliates in general are getting commissions on as many as nearly half of the players that sign up in the US for sports betting. I don't know if that's true. I definitely wouldn't state that as a verified fact, but these companies are acquiring most of the big traffic centers. Now that's changing now because a lot of it's now going through TikTok and Instagram. People are finding ways to send traffic directly from their own personal social pages, but it's a huge percent.
So just to put some random numbers on it and put you on the spot a little bit, I guess last year Better Collective did around 327 million euros and did 58 million euros profit. And off the top of my head, I mean, I'm going to be way off, but I would say Flutter did FanDuel did around $1 billion, DraftKings did around $1 billion. Let's say the U.S. industry collectively is worth $5 billion-ish in terms of GGR. The U.K. is worth about $2 billion-ish. So just doing some quick math, so they're like 10%, 5%? Like 5% of the revenue of sports betting is going to Better Collective. Is that the kind of the right way to think about it? Like $1 out of $20 goes to Better Collective, and let's say they're half the market, like 2 out of a.
I don't
am I
think
thinking
that's
about this the right way. $1 out of $10.
You're talking global. You're talking global numbers.
I'm mixing geographies for sure.
I don't think it's that much. They're also getting revenue from other sources like subscription, for example. I wouldn't say it's quite that much, but I would. If you had to say over under 1%, I would bet it's probably over.
Okay. And so after listening to you, it basically sounds like a rebalancing, belt tightening, like nothing systematic is wrong with affiliates. It's just kind of like a rationalization of the overspend that a lot of tech companies, ours included, did in the 2021 era when capital was cheap and all these kinds of things. So it sounds like things are going to truck along. What's in store in the future? Like, do you think the industry is going to keep growing, or it's, you're going to have it's going to be like sports betting in the UK where there's like 15 providers and it's just going to keep ticking over and they're going to make a little bit more money every year and it's going to be pretty calm? Or do you think there's going to be some reckonings in the affiliate space?
I think there is going to be some reckoning. I wouldn't quite say it the same way you did in terms of it just being a rebalancing. I think there is more going on here. And I think There is a fundamental problem with the publicly traded affiliate model. I think it's not unique to the gambling industry, but I think of it a lot the way I think about like private equity as an example, where you have companies that were started up by founders who were innovative, who created products that maybe hadn't been created before, or that did something different than other similar products had done, or had clever marketing schemes, whatever it is. And then they get bought up by a company that is better at innovating around monetizing than they are at innovating on product. And so you get these companies they're very well capitalized. They've got a lot of very smart people working there, but most of the investment is going into things like ad tech, for example, or improving conversion rates. They have a lot of people working in things like analytics and business intelligence. They're trying to turn a site that makes $1 million a year into a site that makes $3 million a year. But they do it by extracting better commercial deals than their previous owners could, by more efficiently serving ads, by more efficiently, getting clicks from users that maybe weren't clicking where they wanted them to before. They're very, very good at stuff like that, but they're not, it's much harder to sell any of these public companies on the idea of investing into something long-term, something that may make money 3 years from now, getting in this lane that you think is going to be big in the future. They're not speculative companies when it comes to stuff like that. They'll speculate a lot on the ability of a business to grow its revenue, but they don't really speculate on like where users are going to be a few years down the road, the way founders typically do. And so I think it is going to be hard for these public companies to continue to do what they've been doing. I still think they're good businesses, and I think that if they make good acquisitions, they can succeed at continuing to monetize them. But I don't think that they're going to be able to. I think the way they've looked at things a lot of times is that they can be the dominant players and kind of own the affiliate space. And I just think there are always going to be startups that challenge them and that create more interesting products. And when you start seeing rent-seeking behavior in particular, that's when you know that the model is a little bit flimsy. You may not have heard about this in Ohio. There was a law being pushed that would limit the number of affiliate licenses given in the state. And it's just clearly coming from someone who's interested in there not being more affiliate competition. I don't think this is something operators want. They're paying the highest commission to these biggest affiliates. So where's the law coming from? Where's the bill coming from?
You've hit on one of my hot button issues is rent seeking. It must be ended.
They've kind of lost the plot when they're doing that, I think. And the focus, the way you're going to see growth overall in the affiliate sector is through innovation. That's the only way. You can't just grow the business by continuing to make the buttons the right color on your website.
Awesome. Well, before I let you go, what do you want to be when you grow up?
I don't ever want to grow up, Jason. That's my main goal. I think I would have said that in my 20s, and now I'm 43 and I have 3 kids. So I guess in some ways I have grown up, but I love my freedom. I love having, the ability to dip out at 11 in the morning one day where I just don't feel like working and just go to something else. I would like to be like that for the rest of my life. Obviously, being a parent creates some restrictions, but what I really want to be is a free person with free thoughts and free time and not beholden to the whims of some boss somewhere.
Just remember, freedom costs $1.05 if you're lucky.
Yeah.
Thanks for stopping by and sharing your thoughts and teaching me a little bit about the affiliate space, and all the best.
Oh, it's been fun, Jason. Thank you.
Cheers.
The Business of Betting podcast is presented by Optimove, the #1 CRM marketing solution for the iGaming industry. 4 out of the top 5 U.S. operators personalize player experiences with Optimove, the #1 CRM marketing solution for the iGaming industry. Learn more about Optimove by requesting a demo at optimove.com/businessofbetting. And if you like what you see, you will get your first month free.